All right, now go into the interview portion of today's podcast, and I'm thrilled and honored to welcome in Ivan Barratt, the founder and CEO of BAM Capital. So, Ivan, thanks so much for being here.
Thanks, Jay. It's good to see you, man.
Good to see you again. So,
it's about time we recorded one of our conversations.
It's. I mean, enough of them offline. We should give. I want to give the good people here a better picture of everything you're doing at BAM. So one of the things I love about your story is I think you've done what a lot of groups want to do. And so I'd like, if you can, to share some secrets here. You started off as a property management company, evolved into owner-operator, buying apartments, managing your own, then evolved further from a deal-by-deal syndication model to a fund model, another big jump. And now I saw you rank in the Inc. 5000 for America's fastest growing private company. So congratulations. And what's been the secret to the growth?
Well, as we were saying before starting the call here, we could spend a whole podcast on that, right? I wouldn't say there's anything too secret. I mean, thank you for all the accolades. I feel pretty lucky. We started that first, not because I was wiser or smarter than anybody else, but I had this feeling that I needed to figure out the execution side of the business before going big. And I'd been in property management a few years. We're going into 2013, 14, got some apartments, a lot of single families, duplexes, condos, all kinds of stuff. And I was, banging my head against the wall, and employment was a merry-go-round, a turnstile of people coming in and out. And really just had this question, like, what would it take to have a management company where people liked their jobs? What could that possibly look like? And luckily enough, I found some early adopters of that, some really key hires that took that proverbial baton and helped me run with it. And we put a lot of focus on culture and executing on that idea of having a company where people actually like to work and wanted to sort of bang on our door to be part of it. And so we spent a lot of time on that early on, certainly made a lot of mistakes along the way. But it's continued to grow. We focus a lot on culture and taking care of our people. For us, it's funny. I was in a discussion with a bunch of CEOs in our space, and people are debating, in-house property management versus third party. And I heard these things from operators: necessary evil, source of all my problems, my biggest headache. And I think, it really starts with mindset. Problems are a good thing in business because the more problems you uncover, the more you can solve and grow and be better. And for us, management is a beautiful machine of humans who are responsible for executing our wealth objectives for us and our investors. And so we couldn't imagine doing it any other way. It doesn't make us a lot of money. If we were very miserly with how we operated that company, we could eke out a profit margin maybe akin to a restaurant, about 10%. And instead, we take that 10 or 15% in some cases, and we reinvest that in our people. We've got a conference every year where everybody comes in from every property. We spend a lot of money on that, spend a lot of money on our Christmas party, quarterly events, and old school style family reunion every summer, old school cookout kind of corporate event. And we find all these ways to bring people together, to help educate them, to help them grow. We spend a lot of time on core values. We believe very strongly in people, and when people grow, BAM grows. And it's anything but easy. It is not complex. It's not rocket science. It's just really hard to pull off. And when I hear these things in my peer circles about necessary evil and source of all my issues, I get a little twinkle in my eye.
That's great. So I thought you'd have anything but talking about, basics, people, taking care of problems, but you attribute just that foundational approach to growing into an owner-operator, attracting capital. It all comes back to having good people and taking care of them.
People is so much a part of it. Don't share this, just between you and me, but when you pay people well and you take care of them, they tend to stick around, do a better job, and tell maybe a friend or two about how they're treated.
All right. Well, we won't tell anybody besides the few thousand or so who listen to this. So So whenever I post, one of the ways you and I got to know each other a little bit is whenever I post on LinkedIn about the Midwest, you
Oh,
like
here we go.
you like to jokingly tell me to stop telling people about it and to keep the Midwest success a secret. And some others do too. And even though it's a joke, I always find it really interesting because nobody in the coast or the Sun Belt tells me that. they like to talk about how great they are. The Midwest tends to get overlooked in those debates. So my question to you is, why do so many investors, both GPs and LPs, tend to overlook the Midwest?
I think I have the benefit of being born here, and I know we've talked about others that are from the Midwest that invest elsewhere. But growing up here, going through business school, and seeing these changes, especially in the great state of Indiana and in other Midwestern jurisdictions, you saw these early green shoots, this trend with a lot of momentum behind it, successfully decoupling from the Rust Belt moniker of the 40s, 50s, 60s, 70s, and 80s, where manufacturing is being hollowed out, right? And what you've seen in these markets is diverse employment in financial services, life science, education, government, and several other sectors, including in many cases technology, to where now you've got these world-class suburbs with steady eddy growth rates of jobs and population, with safe schools, affordable housing, wonderful downtowns. It's really fun to watch. And then for all these other reasons, you've got larger investors chasing sexier, shinier objects around the country. Sets up for a wonderful value investment play to where I can buy great assets for a fair price and have a high conviction of increasing or enhancing that asset's value through various ways, versus chasing the same assets that many larger investors are chasing. Now, those are great deals in some cases, but they're not getting the returns that we've been able to achieve. And so it only makes sense for us to seek out value. And we're just lucky to be here in the Midwest area and sort of see it up close.
Yeah. You mentioned some of the downtowns kind of sort of anchors some of these metropolitan areas. And I tell people all the time, I think some of these Midwest downtowns are some of those underrated parts of the country. I love downtown Indy, Cleveland, Omaha. I mean, just name a few, make you on the list. I mean, they're just...
Well, let me just correct a little bit. Well, some of those downtowns are doing well. Some of them are struggling.
Yep.
What I would more refer to are the suburban cities, the Carmel, Indianas of the world, that have successfully developed their own downtown or urban centers. And then they've also got the safety and the schools and the jobs. And that paints a really great picture for multifamily.
Absolutely. And I agree with you, by the way, in the suburbs too. I just think sometimes having a good, solid downtown helps the entire metro area, including those suburbs where, obviously there's going to be more apartment investment.
For sure. Sure.
So you alluded to this, but there's plenty of Midwest GPs we both know, based in the Midwest, who invest heavily in the Sun Belt and not so much in their own backyards. And we talked to them privately. A lot of them told me it's just harder to raise capital for a Midwest strategy. So, kind of building upon what you just shared, how have you found success selling investors on the value of the Midwest?
That's pretty easy. The returns speak for themselves.
Yeah.
We just had our 14th exit. Our average IRR has been a 35 handle on a 5-year hold. A 35 on a 3.5-year hold.
Wow.
And almost 2.5x multiple of investment. And so we've returned well over $200 million out to our investors. So those early full cycle deals helped a lot with the momentum of repeat investment, new investment, referrals. We also got a lot of early adoption in Southern California. Many of our early management clients became some of our first syndication investors. And there were a lot of Californians that liked the Midwest story.
Mm-hmm. Yeah. Well, that's great. I mean, returns speak for themselves. So that's an impressive story. All right. So just playing into your wheelhouse here, for these last few years and probably again in 25, we've seen the value of the Midwest playing out, the steady eddies. The Midwest doesn't see these crazy growth numbers. We didn't see that during the pandemic, but we also didn't see bad numbers. We didn't see crazy numbers on either side of it. It's been that steadiness has played out. Today, the Midwest dominates the national rent growth leaderboard with very sustainable rent growth numbers in the 3 to 5% range for the most part. And with that, we have seen some more capital getting interested in the Midwest, even at an institutional level. So I'm curious to ask you, as somebody who plays in the Midwest all the time, is how is that increased profile and increased institutional interest impacting deal activity in your markets, particularly your bigger markets like Indianapolis and Kansas City?
I'll take Indianapolis. There's certainly periods here where I can't get a deal done. Where larger investors are coming in and they're just willing to take a lower return and pay a higher price than my strike. Again, I've got to pay a fair price for a great asset and have that high conviction that I can enhance NOI. And so oftentimes we will exit that secondary market or put it aside for a while and go after the tertiary markets where we know we can still find value. So Indianapolis definitely seems to be back on the radar of a lot of folks. Columbus, Ohio, certainly getting a lot of credit with some of the chip manufacturing, and now Anduril coming in with a large injection of jobs. And so here, like anywhere else, you will get these periods where the bid of the larger institutional type investors pushes us to find value elsewhere.
Yeah. So speaking of elsewhere, obviously BAM's operating heavily in the Indianapolis metro area. Also, you're in Iowa, Illinois, Missouri, Arkansas, Ohio, Pennsylvania. So other than KC and Indy, I describe most of your markets as secondary or tertiary, at least on national definition. Obviously, it's subjective definitions. But what markets are you finding especially strong right now?
Well, I'll bare my soul on a lot of things, Jay, but talking about markets, I think this year it's still sort of a toss-up. I'm sure we're going to get a lot of good information out of NMHC. I think transaction volume should start to stabilize and increase. In 2023, we were buying deals in Indianapolis, and we were the only bidder at the time, which was a fantastic time to buy. I would not be surprised this year if we're more in the tertiary markets of some of those states, which is. You got me wanting to tell you some of those markets, but I'm gonna bite my tongue, Jay. Keep those markets to myself. But they're out there. Our audience, those who are operators, know how to find those markets. There's some great smaller cities here in the Midwest that are growing above the national average, and supplies is in check. New supply is in check versus the market. Whereas some of these larger cities, you're seeing a lot of increased supply, and we know that that'll burn off eventually, you and I. But in the meantime, we've got to find ways to make value now.
All right. So I don't like giving too many secrets away, but can I ask, are there any markets you're not in today that you're looking to expand into? Anything particularly intriguing to you?
I've got a really great acquisition team that runs out in front with the brokers. And I'm sure if I had one of them in here, they'd give you a couple sweet nuggets of markets we might be interested in. If I had to guess today and look at my crystal ball for 2025, my hope would be that we are continuing to scale in markets that we've entered in the last 18 months, such as Kansas City, Pittsburgh, Pennsylvania, and those suburbs. Maybe another deal in Rogers, Arkansas. That's a small city that's growing like crazy. Walmart's really starting to pick up the relocation strategy for their corporate headquarters. So in general, we'll still be doubling down on what we like, which are those secondary and tertiary markets throughout the Midwest. We're suburban garden guys. We're looking for those Class A suburbs with great schools, great safety, and a diverse jobs picture.
Yeah. Certainly Northwest Arkansas is one that's definitely growing in profile for some of the reasons you mentioned.
No secret shared there. It's out.
Yeah. I've always seen people always debate, these, kind of silly social media debates like, hey, what's the next Austin? It's like, oh, it's Northwest Arkansas. It's one of the places you'll pick. It's going to be a while before
we'll
it's
see
Austin.
about that. We'll see about that.
It's a beautiful area though, too. All right. Well, we're doing well on time. So I want to ask you another kind of random question here. Is you went viral last year for a post on meeting Jamie Dimon. And it was pretty cool. And some of the lessons you pulled away, you posted on this. You had, I don't know how many thousands of people who liked that post. But do you tell us a little about meeting him and what you took away from that conversation you got to have?
Yeah, I usually avoid those after hours business networking events. But my banker calls me and says, "Hey, Jamie Dimon's coming to town. Would you like to attend?" And for me, like I said in the post, that's like meeting Michael Jordan or Kobe. And I happened to walk in about 5 minutes early, and he's standing right by the door talking to a couple of people. And I had heard that he runs a lot of his organizational uh, delegation, team strategy, what he's handed off on a sheet of paper. And so I asked him about that sheet of paper. And I try to follow whatever Jamie's talking about. I have a lot of respect for the guy. But that night he lit up and told me all about that. It's full of chicken scratch, but it's all about what he's given his team, what he's asked for from them, all the deliverables they owe him. And it was just a humbling reminder that sometimes it's not finding the next tech stack or finding the next hack on growing a business. It's just simple, fundamental basketball in a lot of ways. Similar to our basketball state here in Indiana. He's talking a lot lately about inflation. I am fairly in line with what Jamie said, that most roads lead to inflation. There's inflationary forces in the U.S. that aren't going away anytime soon. Rising labor costs, reshoring of manufacturing, a multipolar world, all these things that are changing the very fabric of our landscape, and we're leaving one age of that post-World War II dominance to a multipolar world that'll be very different than the one we're exiting. And it's fun to watch. It can be a little scary, but there's also, I think, a lot of opportunities. And in every circumstance, many people will need a roof over their head.
Yeah. Yep. No, I tell people all the time. I say you could shop from anywhere, you could work from anywhere, you could buy food from anywhere, but you need a place to live. So apartments provide that.
You need a place to live. And I don't see the Midwest slowing down anytime soon. I think there's a lot of steady forces, steady trends that are pointing the Midwest in the right direction.
Yeah, it's interesting anecdotally. I'm sure you see this since you live up there, but I'm in Texas. You're in Indiana, and I hear so many stories about people who grew up in the Midwest, moved out for stage of life,
Sure.
and in past generations may have stayed wherever they relocated. But you hear stories you'll move them back because they're able to have some flexibility in terms of where they work, or maybe there's better jobs now available where they're going in the Midwest. So it certainly seems, obviously not every Midwest city is the same, but there certainly seems to be an increasing bull case for the Midwest in this next couple cycles.
Yeah, Indy, I'll try not to screw this up. I just read this morning. Indy now was number 8 on the list of one-way U-Haul trips into the market. As a leading indicator of in-migration. Number 8.
Yeah, that's great. I tell people all the time, I think Indy is like the most Sunbelt-like Midwest market, meaning like younger population, it's a stronger job base. You look at just demographic characteristics, it behaves a little more like a Sunbelt market than some of the other Midwest cities.
What markets are you looking at outside of Texas?
Well, the places that we're looking a lot in the Southeast, but if I were going to the Midwest, I love obviously your town of Indianapolis, love Columbus, Ohio. I think that's going to be a growth market. Obviously, others think the same. That's another hot market for buying right now. Kansas City, and then one that I've been bullish on for a long time on the smaller market side is Grand Rapids, and that one's seen a lot of growth. And certainly not really a secret about those who operate in secondary Midwest markets, but that's another one that's got a lot of great demographic and employment drivers in that one.
Well, I'll second that. Grand Rapids would be a market where we're underwriting assets and looking for opportunities.
Yeah, and I think there's a case. I mean, I always say it all the time. It's like, and this, like any market, you can find the right deal and right opportunity. Cleveland is one, like just to throw an example. It doesn't have the best, headline stats on anything, but there's some great parts of Cleveland that I think people can do really well, and they can make the same case on other markets as well.
Well, and that's the trick, right? If we're always chasing the hot thing, that it's going to be difficult, if not impossible, to make those returns to keep investors coming back.
Yeah, absolutely.
Yeah, you got to sort of look where the baby's getting thrown out with the bathwater.
Yeah. You see, it's finding opportunities, right? I mean, what's getting ignored? So all of a sudden, there's value you can't find elsewhere because of the function of less buyer competition.
Couldn't have said it better, Jay.
All right, so just to close us out, what's next for BAM? What's on your radar for these next few years? How will you continue growing?
Well, like on a macro level, it's how do we continue to do this thing at a higher level? How do we continue to scale really, really well while maintaining the culture that we've created? So protecting that culture we have on the management side that is really, really humming along. The last few years, we feel pretty blessed to raise about $100 million a year, a little over $100 million of equity deployed.
That's great.
Certainly put a lot of our own capital to work to get all the opportunities that have been coming. And so now it's just continuing to double down on that and expand our ability to meet new investors and build trust and build relationships so that they invest alongside us. And so it's not really anything new or earth-shattering. We've got 3 strategies now. We joint venture with developers. We've been at this income fund model now for, going on 5 years, I want to say. And now we've transformed that income fund into an evergreen vehicle so that it can continue on the most efficient manner possible. And then that dovetails with our acquisition strategy at the fund level. So Fund 4, we're getting pretty close to wrapping that up. Fund 5 will be next. They tend to be a little bit bigger as we go. And so continue to incrementally grow the company. You mentioned the Inc. 5000. That's 7 years now in a row that we've made that with the 5,000 fastest growing companies. But more importantly to us, it's those accolades we've been getting in culture and best workplaces. That's really how you grow something special. And if other big companies can do it, we can certainly figure out a way to get there as well.
All right, so I got to ask you one last question. You mentioned closing the raise on Fund 1 into Fund 5. I mean, even though you're in better markets in terms of growth right now, revenue growth right now, rates are what they are. GPs have a hard time raising capital these days. I mean, is it still tough, even though you're in better performing markets?
I have spent more time and more resources to raise $100 million than I thought I would. It's still tough. I'd like to think that we do it better than most and that we have a wide audience, a big pool of investors to raise from. The RIA network has been very good to us, putting the infrastructure in place to service wealth managers, being on Charles Schwab, being on Fidelity, being on these other platforms that are not easy to get through the due diligence, rectal exam that's required. But that bring in those wealth managers alongside of us and to be a partner with them has helped accelerate that capital raise and maybe some institutional announcements in the near future.
Oh, okay.
Still sticking to our tried and true retail platform. We've got well over 1,400 investors now. I think our smallest check is $200,000, and our biggest one is somewhere around $15 million.
That's great. Well, congratulations on all the growth, and it's a success. And thanks for spending some time with me today.
Yeah, anytime. It's good to be here, man. Thanks for having me.
All right. Thanks again.